Good afternoon. This is Arlan Suderman, Chief Commodities Economist with INTL FC Stone, here to talk to you about the June 30th USDA crop report, with USDA reporting the results of its June 1 acreage and grain stocks surveys. So let's take a look, and first of all, need to be sure and to put our disclaimer page up, give you all an opportunity to look at it and read through it. And we're going to be looking at the surprises that were contained in today's crop report and the implications of those surprises. And surprises for the trade more, we were pretty pleased with our analysis this time around. You know, maybe next time we won't be so fortunate, but this time around we felt pretty good about where our analysis prepared us for these surprises. First of all, this is also another key time for going back and reminding ourselves that price is a function of supply and demand as modified by the flow of money. And the flow of money, I think, is playing a critical role in this market right now. Remember back in the month of June when we had a weather scare. In fact, we had one of the more intense heat waves in record for the early part of June. Now, granted that that's early in the growing season, so that's part of the factor. But the weather market, the weather rally, I'll call it, in the grains was rather muted at the time. Part of the reason it was muted is because the funds were very bearish the commodity sector at the time. And so they interpret any fundamental information that comes their way through the filter of that lens of whether they're bullish or bearish the commodity sector. They were bearish the commodity sector, and so corn really struggled to get any type of a rally going. And as soon as the weather cleared up, we saw corn not only return to the range that it was in previously, but drop below that range, a range that had held the July contract, for example, for most of the last 8 months, other than a rally that we had back in February. So the perspective or the background of how the funds are viewing the commodity sector does make a big difference. And in previous presentations, I've showed you that from history, how it actually makes a big difference in a cash price received at the farm as well. So within that context, first of all, let's look at the dollar. Again, this is a weekly chart going back 8 years. And we're looking at, first of all, we saw the sideways trading motion that we saw through the last part of 2014 and much of 2015, and then the rally that we saw, particularly into the elections in the 1st of January, on expectations that we would see the Fed increase monetary tightening, in addition to, after the elections, a belief that there would be fiscal stimulus. But two things have happened since then. First of all, the hopes for fiscal stimulus getting passed by this Congress have started to decrease. And some of the economic studies, including a consumer sentiment study that came out this morning, showing declining confidence that Congress is going to be able to pass that through. The other factor is the competing economies, the currencies of the competing economies like Europe and Japan and elsewhere have started to improve. So their currencies have started doing better. Their central banks are now starting to show signs of moving from stimulus into tightening mode. And so that's helped lift their currencies and started to be a drag on the dollar. And so we see that since the first of the year, the dollar index has been in this descending channel on the charts. And then this week, it actually broke through the bottom of that channel. You're clear on the right-hand side of this graph. Now, typically, the historical tendency is for the dollar to move in the opposite direction of the commodities. As the dollar is going lower, we tend to see money flow into the commodities to rally them. As the dollar is going up, we tend to see them sell off the commodity sector. But really since the election, well, really since the first of the year, well, I'd go back to the election because first we saw them rally together, but since the first of the year, we've seen them sell off together. And I've been anticipating that at some point we would return to that historical relationship. And one of the things that's watching for is whether the dollar would get cheap enough to start spurring some value buying in the commodity, saying, hey, these commodities are multi-year lows. This is the time to buy commodities. And it looks like that may have happened. It's too soon to confirm, but the break below that channel this week seemed to also come along with a change in attitude of the funds. And we'll look at some of the major commodity indices charts here in a little bit. First is the CRB Index, which is a basket of currencies. Indices are baskets of 17 to 25 commodities. The CRB tends to be heavily weighted toward the energy sector. In fact, 39% is energy, 23% of it's crude oil. I watched this one, and I watched the continuous commodity index because it's equally weighted. And as I monitor differences in how they perform, I can gauge then the influence that crude oil is having. And is crude oil the leader, or is crude oil a follower? And for most of the time, crude oil is a leader, although we've had some times of late when it was a follower. Notice that this weekly chart covering the same time period, how we broke through chart support here this past month, and here this week we have failed to take out the previous week's low, and in fact it looks like we're going to be able to close above the previous week's high. I don't have closes on here yet, but anyway, very close to or above last week's high. So that is a positive. It's not a reversal, weekly reversal, key reversal where you make a new low, new contract low, and if you're talking about futures contracts, and then you settle above the previous high. But it is a good sign, a positive sign. It's not an absolute sign, but it certainly is helpful. If we look at the daily chart, so here we're backing up to last September to the current, we have something a little bit more encouraging. See this gap right here on the downward side, we gapped lower, then we started consolidating, and we gapped higher. That leaves what we call a bullish island reversal on the charts. And it looks like we've confirmed this bullish island reversal with another gap higher here on Thursday. So that could always get negated if we go back and refill both of those gaps, but for now it leaves a bullish island reversal on the charts. What does that do? Fund managers who are watching these charts see that, and if they've been writing short positions in these indices and in essence then in the commodity sector for a long time in very profitable positions, they see that and say, it's time to take profits. They start unwinding those positions, and that in essence produces the buying in the commodity sector. And if it happens at a time when the grains are rallying anyway, it can enhance and you get a larger rally than what you would otherwise expect. Excuse me. So as we look at the continuous commodity index, which is not overly weighted toward the energy sector, we see a very similar weekly chart, and the daily chart also has this bullish island reversal on it, and a couple of gaps higher. Thursday gapped higher, and then Friday gapped higher as well. So very positive sign, not a guarantee, but a very positive sign, something that traders pay a lot of attention to and oftentimes becomes self-fulfilling. So I'm very encouraged by this development and what this means for adding volatility, positive volatility for the grain markets. Now, let's take a look at this June 30th report. This is a graphic that USDA actually put out and with their March 31 survey, and I wanted to use it again to demonstrate something. USDA surveyed for the March Planning Intentions report here in late February and the early part of March. Then we had a break of kind of a lull before the planting actually got started. Red here shows a typical planting progress for corn, green typical planting progress for soybeans, and then you see shaded here also the survey period for the June 30th planting survey, which was reported today. It starts in late May, continues through much of the first part of June. Note that most of the corn is typically planted by then, but there's still the last quarter to or so of the soybean crop that still wouldn't be planted, especially the double crop. Quite a few soybeans wouldn't be planted. So that does leave the room for some error there, where intentions around the 1st of June get changed by the weather, etc. The other thing that I want to point out, which led to us having one of the highest, if not the highest, depending on the survey that you follow, industry survey, acreage estimate for corn at 90.61 million acres. USDA survey, again, was late February and early March. Our survey was mid-March. We saw corn rally relative to soybeans during the month of March. And we heard anecdotal stories of farmers who had been planning on switching significantly to soybeans, backing away from that switch, moving back toward corn on some of those acres. So USDA survey that was founded in data from late February and early March said just shy of 90 million acres of corn. Our survey said 91.6 million from the survey it was taken in mid-March. What we saw then was planting problems and replanting problems switched some acres back to soybeans. So corn acreage did come down, but from a higher number than what was reported by USDA from their survey that was reported on March 31. That's why we had a 90.61 million acre corn estimate. Soybean acreage, we felt like actually came lower than what USDA reported because of that mid-March flip from soybeans back to corn. And then as we had planting problems with corn, went back to soybeans. That's why the increase in soybean acres reported this morning was not as big as expected by the trade, is because there was a gain in soybean acres, but a gain from a lower number. And so that helps provide a little bit of an explanation as we go into the numbers. Now, here's the stock numbers from this morning. Note that USDA said 1.184 billion bushels of wheat existed on June 1st, which was the beginning of the new marketing year, the end of the old marketing year. So this is the ending stocks number now for the 2015-16 marketing, 2016-17 marketing year, and beginning stocks for the 2017-18 marketing year. This was, 47 million bushels above the average trade estimate, but we feel pretty good about this number right here. We're just 2 million bushels below that. That suggests that wheat feeding wasn't as much as what USDA indicated, and final wheat shipments were not as much as indicated. I've been watching the Census Bureau data and been projecting a lower export number based on that. So the combination of the two, we came pretty close. On corn, USDA June 1 number, 5.225 billion bushels of corn on hand. The trade was looking for something 102 million bushels less than that. I was looking for 22 million bushels less than that. What this number does is confirm my feed usage estimate, in my opinion, of 5.4 billion bushels versus USDA's feed usage number of 5.5 billion bushels. Excuse me. We'll see how USDA plays it out in their balance sheet on July 12th, and where they'll incorporate this number into adjusted demand figures. But that's what I think needs to happen, is USDA lower its feed usage number by 100 million bushels. Excuse me. Soybeans, 963 million bushels. The trade was looking for 983. I was looking for 972. This is a little bit of a challenge. We know what most demand is in the way of exports and crush, both of which are measured. So this comes down to residual use and trying to anticipate residual use. And what is residual use? It's a measure of whether USDA overestimated or underestimated the size of last year's crop. So perhaps this 963 million bushels, maybe USDA underestimated a little bit, or excuse me, overestimated a little bit the size of last year's crop, and maybe make that adjustment come this fall when we're focused on the new crop. But overall, we were pretty close there, just 9 million bushels away. On acreage, I've already went over our estimate of 90.61. The trade is looking for a decrease to 89.903, came in at 90.9 million bushels. Bigger increase in Michigan than I expected. They were up 200,000. That was part of it. But overall, I think we were on the right track and the right path. I mentioned soybeans, 89.513 million. Trade is looking for 89.750. I was looking for 89.850. All week, 45.657. The trade was at 46.07. I was at 45.76. Feel pretty good about that. And that was largely because of a shift toward fewer spring wheat acres. I actually had a much lower spring wheat number, and I gave in to peer pressure, I guess, and I still had a lower spring wheat number than most, but not as low as I originally was, and so that's why I missed it and didn't quite capture all the decrease there in wheat. We'll talk about the implications here in a little bit. Excuse me. When you look at state by state at all the principal crops, you see that there was basically an increase in acreage in Minnesota, Iowa, Wisconsin, Nebraska, Michigan, Indiana, Ohio, in some of the southeastern states, and a decrease in a lot of the other states. So a shifting around of acreage somewhat. In corn, this is the shift from last year. North Dakota up 250,000 acres. Wonder how that's doing in the drought. Although, I have to say, most of those corn acres are in the areas of the east that are doing better on rainfall than what is the west. So it's not a total loss there, but it does have an effect. Kansas up 200,000. Michigan up 100,000. Most other states are down. Now the West Coast, we're seeing a little bit of an increase. That's more of a minor production area from the principal field crops that we're talking about. But most of the principal growing areas saw a decrease in corn acreage from last year. Now, what about the change from March? Well, 400,000 acre increase in the northern plains coming out of spring wheat going into corn. We anticipated more of that would go into soybeans than went into corn, and that's one reason we missed it on soybeans and didn't quite catch the increase in corn, although we were pretty close overall. And I mentioned the extra 200,000 acres in Michigan from what we saw in March. But a decrease of 200,000 in South Dakota, decreases in the eastern Midwest other than Michigan. But the plains states largely saw some increases, especially, as I said, North Dakota, Nebraska, and Kansas. Iowa up 200,000 acres as well from March. Grain sorghum up 200,000 as we dropped some wheat acres and actually as we saw some wheat be hayed, cut and made out of hay. Some of that after the winter storm that we had at the end of April, 1st of May, but more grain sorghum acres there. So we look at soybean planted area up almost across the board, and where we saw the increase, 500,000 acre increase in Nebraska and Iowa, 700,000 in Kansas, 400,000 in Missouri, 1.15 million acre increase in North Dakota. So big increase there, 650,000 acres in Minnesota. What about changes from the March survey? Up 300,000 in North Dakota. So increase in soybean acres from March there as well. 250,000 down in Kansas, 200,000 up in Illinois, 100,000 down in Indiana. Combined corn and soybean acreage changes from the previous year. You can see there Kansas almost 1 million acre increase in corn and soybeans as wheat dropped a similar amount. Corn and soybean acreage almost 1.5 million acres higher in North Dakota, once again where they're encountering more stress. Cotton acres, throw that in for your interest's sake. See how we are increasing cotton acres almost across the board. I find it interesting to look at Kansas nearly doubling its cotton acres. Not a lot there, but almost doubling is simply looking for options. And frankly, the economics will work much better this spring for cotton than it did for most of the crops if you were someone who had access to the equipment in order to grow it. So we look at winter wheat acreage down, of course, down 1 million acres in Kansas, down 250,000 plus in Nebraska, 250,000, just shy of 250,000 in South Dakota. But overall decreases almost everywhere versus soybeans were increasing. And spring wheat acreage, look at 750,000 acre decrease in North Dakota. And we certainly heard a lot about that, particularly with the planting problems this spring. Excuse me. And the change in spring wheat acres from the March 31 estimates, 500,000 acre drop in Montana, 180,000 acre drop in North Dakota, but a 200,000 plus acre increase in South Dakota. Now, let's talk about the weather. Basically, the top left graph shows that we're expected to stay in a neutral, warm to El Nino, weak El Nino weather pattern. No change there. So that leaves us focused then off of conditions off the Baja California as well as the Gulf of Alaska. And one of the things we've been talking about is the strong jet stream expected to be a factor across the Pacific and into the United States this year. That jet stream has not been as strong as what the model suggests that they would be. And when it is weakened, we have seen drier patterns develop over the Midwest, as we saw in June. When it is strengthened, as it is right now, we have seen a wetter pattern. Right, it's currently looking like it's going to weaken again over the next couple of weeks, drying out the Midwest again as we go into pollination. Commodity Weather Group is sticking with its overall odds on 26% odds that we'll have a hot and dry Midwest, so not very good odds right there. 16% that it'll be warm but wet. 10% that will be dry but cool, and 48% odds of cool and wet Midwest growing season. So what does Commodity Weather Group say in their forecast? First of all, let's look at the near-term forecast. Near to below normal temperatures expected over the next 5 days for the Midwest, with below normal in northwestern areas of the Midwest, above normal across much of the southern and eastern part of the belt. As we go into 6 to 10 day outlook, much drier outlook, and the warmth starts building in from the west. Not a dome of doom, but warmer weather to add stress to the crops in that area. In the 11 to 15 day period, that warmth kind of shifts a little more to the north and lies east. Fairly dry here, Illinois, Missouri, parts to the north and west of that. As we look at the longer term outlook, first of all, we have the 16 to 30 day at the top, relatively mild for the Midwest, dry, northwestern half of the Midwest. The month of August, mild to, I'm going to say, below normal temperatures, and precipitation is currently expected to improve. This would be very good for soybeans. The exceptions here is parts of Wisconsin and Minnesota. And of course the South as well. As we look at the month of September and the harvest, here again, cool weather. We'll have to watch for the possibility of early frost and turning wet in previously dry areas of the plains, and then also turning wet in the southeast. So we look at corn pollination. Basically, the bulk of the crop is expected to pollinate between June 10th and 20th. Some of the driest areas here are outlined in black, which is central Illinois, expected to miss this week's rain, as well as the western Midwest. But I think beyond that, we're going to be drying out a larger area if this forecast holds. Okay, now this is a model graphic from today's midday model. USDA's 15-day outlook at the top. The latest change in the model here in the second row, and what that leaves us as a percent of normal. Orange would be below normal, the white would be normal, greens would be above normal rainfall. And then we see the latest temperatures down here. The bottom line I want to show you is the amount of dryness across the Midwest, and also the amount of warmth building in on this. This has been a little bit unusual to have warmth. We had it in early June, but to see this play out in 11 to 15 day period, critical period as we're approaching the month of June as far as pollination. And here again, this is an interesting one. This is Commodity Weather Group's prediction of what the 6 to 10 and 11 to 15 day maps will look like this coming Monday. So not today's 6 to 15 day outlook, but what they think Monday's 6 to 15 day outlook will be. It's pretty dry for the bulk of the Midwest, warmth primarily in northwestern areas. If we look at corn condition index scores for the current week versus the same week in all the previous years back to 1986, which is the longest USDA has been keeping records on this, we find that the corn rating is a little bit below average. Average is fairly variable this time of year. But even as you look at that, it's very similar rating back here in 2012 produced a near trend yield. So soybeans were pretty close to average in crop ratings for this time of year. Current ratings don't mean a whole lot. Now, we did another Twitter survey with roughly 1,000 to 1,100 people, generally expecting corn yields to be below trend for the most part, 55% of them, 25% normal, 13% above trend. Soybeans, not quite the confidence level maybe we've seen sometimes in the past, but normal yields were better than 1 and 3 expecting normal yields, 2 and 5 expecting below trend yield. That's significant for this market. And then wheat, also a bias toward below trend yields, although we did not differentiate between winter wheat and spring wheat. So if you put it all together, the left-hand bar gives what my current 2017-18 ending stocks estimate is, of 1.9 billion bushels. That is down from the current year, but it is still adequate. It does not suggest rationing is required. I use the same acreage on each one of these at 90.886 million acres, what USDA reported today, but I varied my yield. The yield in the first column, I use a 166.8, which is kind of between our models right now. One model is a national model, the other is a compilation of state models. So the national model, I think, is at 166.6. The compilation of state models is at 166.9. So I used a 166.8. And adequate stocks, marketing your average cash price at 360. If, on the other hand, we see a better yield unfold with corn coming out of feeders, so to speak, lost my train of thought. Anyway, using the same acreage here, a good yield, what USDA's got a yield of 170.7, and overall that leaves us with ending stocks of 2.2 billion. I think it's going to end up being a little bit lower than where we finished the year this year, because I'm looking for USDA to have to adjust exports and feed usage. But it's moving in the right direction, still argues for marketing your average cash price at 335. On the on the bullish scenario, what if we end up with on the corn, on the bullish scenario, a 160 yield? That makes things a little bit more interesting. Ending stocks dropped to 1.4 billion bushels. That suggests a marketing your average cash price of 465. That is what the trade is building in some risk premium in right now for that possibility. And that's what we're guarding against. On soybeans, I'm anticipating ending stocks at 474 million bushels, marketing your average cash price a 935. If we do achieve a repeat of last year's yield, have a favorable August weather, and get up to that 700-some million bushel ending stocks, we're looking at marketing your average cash price at 830 or below. If, on the other hand, we see some stress come into this crop and last into the month of June, we could see our ending stocks estimate drop down to 313 million bushels and a marketing your average cash price at 1013. Note, that we're still at 935 here with this 474 million bushels. So adequate stock still holding above 9 for the most part. I can't rule out a dip below 9 at some point. But if that's with a yield of 47.5 bushels. If we repeat last year's yield of 52.1, then it's a different story. We're probably talking about new lows. So we're going to be watching that July and early August weather very closely. I wanted to show you this map of the wheat. It shows you where the major production areas of the world are, and also what the change is in million metric tons from a year ago. We see the changes in the United States, and I expect that to come down some more. We see drops in Canada, and I think that'll come down some more. We see drops in Ukraine, and I think that might come down some more. And if it does, that puts a lot more onus on the hard red winter wheat crop at this point. We're expecting increases in Turkey, Pakistan, India, China. Almost forgot. China up 17.2 million metric tons. We are seeing some dryness coming in some of those northeast areas. We have to watch that. But basically, most of the crop is harvested now. The quality is pretty good. Probably still see some imports of hard red spring, but overall they had a better crop this year. But if we see continued dryness create problems in Europe and in the Black Sea region, particularly Kazakhstan and in Ukraine, we could see things tighten up in the global balance sheet a bit more. So that's something we're keeping an eye on, which could keep the fund money coming in pretty stout. If we look at the wheat balance sheet, don't have a table here. I have a death by spreadsheet instead. I don't have a chart. I have a table instead. And what I'm basically anticipating is ending stocks coming down to 839 million. Note my old crop stocks at 1.82 billion bushels. That's the number I had there before today's report. That gives us ending stocks for the 2017-18 marketing year, 839 million bushels. That's 38% of annual usage. I'll break that down a little bit here by classification. That's with a yield of 46.7. That is not USDA's yield. Note USDA's yield is 47.3. I'm working with 46.7. I'm also working off of a different harvest number as well. If in fact we have USDA's harvest number and the yield come up to USDA's June estimate of 47.3, that gives us ending stocks of 930, which is about 90 million bushels more. That's 155-day supply, 42.7%. So that is a little more bearish attitude. What we saw last year happen a lot is the traders really want to weigh on this market, be very bearish, but they're starting to say, wait a minute, stocks are in decline. We're not running out of stocks, but we're certainly moving in the right direction, and that's what they're trading. On the other hand, if we drop the yield to 46.2, notice my yields are roughly 500,000 bushels either side of where I'm anticipating it to be. Ending stocks come in around 714 million. That suggests stocks to use at 31.3%. So breaking it down by class, we got plenty of soft red winter wheat. Hard red spring wheat's on the other side of the spectrum. That's why we're seeing Minneapolis at such a huge premium to Chicago with Kansas City in between. USDA will give their 2017-18 by class breakdowns in the July 12th crop report because of the first hard red spring balance sheet, so to speak, and be able then to do the total balance sheet by class. But you can see here, this is definitely being led by the protein wheats of hard red, especially by hard red spring. The other classes of wheat, we have quite a few bigger supplies. So what's the bottom line? What's the take-home points? Today's acreage surprises were pretty close to our expectations. The stock numbers were pretty close as well. Look for corn shipments to start slowing pretty dramatically in the weeks ahead. We've already seen sales drop. Now it's time for shipments. It's all about weather from this point forward. That's why we had the strong gains across the board. Some indications that Watch the money flow, some indications that fund sentiment is shifting more in favor of the commodity sector, and if so, that could really give us larger than otherwise expected gains in the grains right now. So watch the money flow, help your brokers that you work with, watch the money flow, follow the money. That's going to be huge going forward. So follow the money. That'll have a big impact on how far we can take this market based on current fundamentals, but certainly more friendly report than what we've seen in the past when you put it together with the weather. And with that, I'm going to open it up for questions. And once again, be sure to type your questions in, enter them in on your keyboard, and Jake is going to read them to me. So Jake, whenever you're ready to go, I'm waiting for the questions.
Hey, Arlan. Just going to give it a few seconds for some questions to come in.
Okay. Well, I might talk a little bit more about the weather while we're waiting. I think I mentioned that one of the concerns in today's outlook is that we're going to see dryness stress expand across more than 2/3 now of the northern plains spring wheat belt. That'll impact a little bit more corn and soybeans as well, and up to 1/2 of the Canadian prairies. So it becomes a much bigger factor, particularly with their later maturity in that area. So keep and watch on these weather updates. So any questions yet, Jake?
Yeah, we have the first question, Arlan. It comes from Francisco. When is the crucial time for wheat in Europe and Black Sea?
Well, Francisco, welcome. You're faithful in asking questions. I appreciate that. Whereas we're in harvest here in the United States right now, they're a couple weeks behind us. So we're really in a critical period right now of grain fill for the bulk of the crop, especially for the northern, central, and northern areas. Black Sea crop, very similar. This is a very critical time right now, and so we're anxious to see what the final implications are for the dryness. Next question.
We have another question from Bob. Do you see HRS acres dropping further?
Hard red spring wheat acres, will they drop further? It's possible, but I think we're pretty close. Originally, I expected lower acreage. I think USDA should be fairly close. I think that by June 1, most farmers had a pretty good idea and probably ended up pretty close in the survey to where we're going to end up. I think the big change may come in harvested acres. We'll probably see that harvested acres drop a little bit more. Next question.
This one comes, we have one more. Can corn rally higher on just weather despite the bearish report and SA seasonal export increase?
Yeah, corn can. It's all about weather now. If the weather continues to favor warm and dry, I think this thing has a little bit more of a run in it. Obviously, if we get a dome of doom, quite a bit more. And the primary reason I say that is because of the changing sentiment right now toward the commodity sector. That may flip next week, but right now it's starting to get a little bit of momentum. And if that holds true into the month of July, then we could see a larger rally than what we would otherwise anticipate. Any other questions?
Another question from Daniel. Arlan,
okay.
What type of response might be seen on wheat protein premiums for HRW wheat in the plain states like the basis, Wichita, Kansas?
Yeah, we saw some very strong basis, very strong bids for good protein wheat. I'm going to say 12% protein wheat just prior to harvest and at the beginning of harvest on the expectations that protein would be low. That accelerated as we started harvest in the southern plains and confirmed the low protein. But since we have moved further to the north and the west and the proteins have been improving, we have seen those bids start to back off. There's still fairly significant protein bids at the commercial level, but they are starting to back off because we are in essence growing more protein. The best protein in the hard red winter wheat belt in the plains right now has been primarily from the Texas Panhandle stretching up into southwest Nebraska. where we're seeing some better protein. We'll also probably see some very good protein, although low test weights, coming from western North Dakota. We could see some 17 to 19% protein. But protein does still command a premium, but those premiums are backing off as we're finding a little bit more than what we feared in the hard red winter wheat crop.
We have another question from Andrew. You say follow the money. What's the best way to follow money flow?
I follow the commodity indices, and there are a number of them, but the specific ones that I follow are the CRB Index and the Continuous Commodity Index, and they give me a better indication of fund sentiment toward the commodities, and of course matching that up with what we see in the Friday CFTC reports that come out at 2:30 each Friday.
Francisco has another question. With what other agricultural commodities does wheat compete for area?
It depends on where you're at. If you're in the Midwest, it's going to compete with corn and soybeans. If you're in the plains, it's going to compete with cotton, soybeans, corn, grain, sorghum. If you're in the northern plains, it's going to compete with corn, soybeans, canola, sunflowers, and some minor crops. So it depends on where you're at, which crop it competes with.
We have another question from George. How many week delay for corn and soybean comparing to normal years?
How many week delays?
How many week delays for corn and soybean comparing to normal years?
I assume we're talking about the planting progress, and really the planting progress delays are very minor as we finished up. More significant early on, and then we made some significant progress. So I'm not sure if that's exactly what you're asking, but if not, let me know.
This looks like the last question we have right now. Are you worried about higher U.S. global interest rates affecting the USD, the economy, which will in turn affect demand?
Good question. We had some Fed members out this week saying that the economy could handle higher interest rates at the pace that they're raising. Because basically the next rate hike is expected to be in December, another 25 basis points. And I tend to agree that we're still at low enough levels, and 25 basis points rather small. I think the economy can handle it, and I think the impact on the commodities would be rather small as well. So any last questions, Jake?
Yeah, we had two more come in, Arlan.
Okay.
Another one from Francisco. I see oats and rice participating in this rally as well. Is this becoming a global food rally? Meats were already rallying before this weather rally started. Yeah,
I believe so. And it has to do with attitude toward the broader commodity sector, but I've noticed that the foods have generally been leading the way. For a long time, it was crude oil leading, and right now, I don't know how long this will last, but right now I believe the foods are leading it.
We have a question from Jeff. Will our administration's sentiment towards our trade agreements influence our markets going forward?
That's been the million-dollar question. I think those fears have eased somewhat. A couple of factors. Obviously, it's apparent what the reasons were because of the rhetoric coming out of the White House early on, pre-election and post-election. But the cabinet members that President Trump selected are very pro-business, pro-trade for the most part. And the actions to this point would suggest that his rhetoric was for the purpose of positioning for strength in negotiations, and that he truly wants to keep trade open. So from that standpoint, I think the trade impacts will probably end up being minimal.
We have
any other questions? Okay.
If states in the Western Corn Belt planted more corn according to USDA this year, and those states have and are expected to have weather issues. Is this an additional bullish sentiment from your point of view?
Yeah, I don't know if it's bullish sentiment, but it is a bullish bias. Maybe that means the same thing. I do think that makes a difference. And where a lot of the new acres are is where we are having problems. And so I do think it's a factor, yes. Any other questions?
Yes, we have another one that came in. What should we look for on the end of the third week for the July crop progress report. Will the pollination at July 20th being a major pivotal point for the new crop?
We should be, the bulk of the crop should be at the 50% pollination level at that point. So come the third week of July, if we've seen the weather straighten out, then the weather market's over for the most part in all likelihood. If the weather is not straightened out, then and we're still assessing damage, then we can see it continue. Now, if the weather straightens out, we can see a pullback, but then we're going to be looking at the August crop report, which are the first actual field survey-based yield estimates. And so if the various private estimates are going to be coming out, we'll start having private tours, I believe, starting the last week of July, all the way through about the third week of August when the Pro Farmer Tour is. So we'll start getting feedback from the field, and that's what we'll trade then at that point.
Looks like we have one last question from Greg.
Okay.
What is your latest 2017-18 hard red spring wheat carryout number? Earlier this month, you were 97 bushels.
Oh, I knew I should have brought that in here. We're at, I don't remember the stocks number, but we're at about a 52-day supply. So it's not running out, but that's a little bit more snug than what the trade tends to be comfortable with. So I was surprised by that when I run the numbers, but it does leave us fairly tight relative to where we've been. That's a month and a half supply, and here not too long ago, a little over a month and a half, not too long ago, we were at a 7-month surplus, so that's a huge drawdown, and I think justifies higher wheat prices, at least confirming multi-year lows and bringing prices higher, but we still need to have a smaller hard red spring wheat crop to keep that rally going, and if that rally fails, I could certainly see us pull back and trade some volatility back and forth for a while.
I don't see any more questions, Arlan. That should be about it.
All right. Thank you very much, everybody. We will be back I guess it's a week after next on July 12th for our USDA WASDE report. I look forward to seeing you and talking to you then. Thank you.